Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Zhejiang Leapmotor Technology Co. Limited annual report. Zhejiang Leapmotor Technology Co. Limited is a leading provider of new energy vehicles globally. The company's business scope encompasses various aspects of the electric vehicle industry. Firstly, it engages in the research and development, production, and sale of new energy vehicles, including smart electric sedans, SUVs, battery electric vehicles, and strategic models. In addition to vehicle manufacturing, Leapmotor Technology also provides electric vehicle charging operation services, ensuring that its customers have convenient access to power their vehicles. The company's after-sales services cater to the needs of its clients, providing technical support and maintenance for their vehicles. Furthermore, Leapmotor Technology is involved in new energy vehicle retail, offering a platform for customers to purchase and own electric vehicles. Its technical service and development department focuses on improving the performance and efficiency of its products, while its warehousing and sorting services facilitate the efficient distribution of vehicles and components. Overall, Zhejiang Leapmotor Technology Co. Limited is a comprehensive provider of new energy vehicle solutions, offering a range of products and services that cater to the needs of customers worldwide. Zhejiang Leapmotor Technology Co. Limited maintains a market capitalization of $65 billion, broadly in line with the industry peer group. Zhejiang Leapmotor Technology Co. Limited trades at a higher price-to-book ratio of 4.03 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The net income of the company underwent a significant transformation in recent years. Initially, it was reported as a loss of RMB 12.82 billion, but this figure improved dramatically to a profit of RMB 0.54 billion. This represents an increase of RMB 3.36 billion, indicating a substantial shift from losses to profits. The improvement in net income can be attributed to the growth in gross margins. The company's gross margin increased by 6.1 percentage points, reaching 14.5%. This significant expansion in gross margins is likely to have contributed to the improved net income, as it suggests that the company has become more efficient in its operations and better able to control costs. The company is indeed generating positive operating cash flow, as evident from the multiple pages of financial data. The net cash generated from operating activities for 2025 was a significant RMB 12.62 billion. This figure is consistently reported across various pages, including page 2, page 10, and page 20, further solidifying its accuracy. The consistency in reporting also suggests that the company's operations are generating sufficient cash to cover its expenses, resulting in a positive operating cash flow. This is a crucial indicator of a company's financial health, as it demonstrates its ability to generate cash from its core business activities. The company's debt level and interest expenses have undergone significant changes over the past year. A notable increase in total borrowings by 25% has been observed, with non-current borrowings rising by a substantial 107%. This surge is also reflected in the total liabilities, which have increased by 76%. Furthermore, long-term bank borrowings have seen a rise of 39.6%, while unsecured long-term other borrowings have jumped by RMB 71,372,000. Consequently, interest expenses on bank and other borrowings have skyrocketed by 83.3% from RMB 0.06 billion to RMB 0.11 billion. Additionally, the company has paid significantly more in interest for its borrowings, with a substantial increase from RMB 26,368 in 2024 to RMB 113,529 in 2025. These changes indicate a notable shift in the company's financial landscape, warranting closer examination of its debt management and interest expense strategies. The performance of various regions and segments has been a key area of focus for Chinese passenger car brands. Among the standout performers are Europe and China. In Europe, the brand achieved a strong performance in Q4 2025, ranking second among Chinese passenger car brands. This success can be attributed to the brand's ability to adapt to local market preferences. In China, the brand excelled by ranking first among emerging auto brands in export volume in 2025. This achievement highlights the brand's growing presence and influence on the global stage. Furthermore, South America has also seen rapid expansion, with over 30 stores established in Brazil alone. While these regions have shown impressive growth, Asia-Pacific has experienced moderate growth, with more than 50 outlets established. Although this may not be as remarkable as the achievements of Europe and China, it still represents a significant milestone for the brand's presence in the region. Management is optimistic about the company's outlook, citing sufficient capital resources to finance ongoing operations. This confidence is further reinforced by expectations of a significant increase in free cash flow from RMB 6.32 billion in 2024 to RMB 7.82 billion in 2025. While management acknowledges the possibility of seeking external funding if needed, they currently do not have plans for material investments or acquisitions, indicating a cautious yet stable approach to financial planning. Concerns about inventory buildup are evident in the recent data. The value of inventory has seen a significant increase, with raw materials and spare parts rising by a staggering 152%. This surge is not limited to just raw materials, as finished goods have also increased by 81%. Furthermore, the provision for impairment of inventories has also risen, indicating potential issues with inventory management. These numbers suggest that companies may be struggling to manage their stock levels effectively, leading to concerns about inventory buildup and potential supply chain disruptions. That concludes the financial summary for Zhejiang Leapmotor Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.